Institutional investors pose a very real threat to homeownership, and for as hard as it seems that they try and keep out of the proverbial limelight by investing through real estate investment trusts or REITs, the topic has been heating up over the years, especially as national statistics come to the forefront. What started as a mass purchase of foreclosed single-family homes during the Great Recession, institutional investors have now made their presence felt, and hard enough to make analysts predict that investors could control 40% of the U.S. single-family homes by 2030. Driven by skyrocketing home prices and high mortgage interest rates, the U.S. could be very well on its way to becoming a nation of renters if changes don't come to the aforementioned or wages dramatically increase in the U.S. With data over the last few decades showing the homeownership percentage rate reaching its lowest share since the 1980s, the number of homes lived in by renters rising, and with institutional investors finding a serious, stable, and secure profit source made through the acquisition of U.S. properties, it's only going to get worse from here. And why? Because Americans need housing, and it's the largest expense a family has. With institutional investment firms possessing asset values rivaling the national debt, the nation of renters just takes one spark, and that's a real estate crash. Welcome to the Death of Homeownership Part 2, where I will go ahead and discuss how institutional investors can absolutely level your hopes of the American dream. When I speak of institutional investment companies, I'm sure some of you watching are familiar with the names already, or at least have heard of them. But if you haven't, by the end of this video, you'll be well informed. The most famous and influential of these companies are BlackRock, Vanguard, and State Street. To give you a brief history, BlackRock is a global investment management corporation headquartered in New York City. Founded in 1988, it has grown to be the world's most largest asset manager, offering a wide range of financial services to institutional and individual investors, including mutual funds, exchange-traded funds, and advisory services. And like BlackRock, Vanguard and State Street also primarily focus on investment management, offering those same wide range of mutual funds, ETFs, and other financial products. But all three focus on passive investment strategies available in the markets. As of 2023, BlackRock manages over $10 trillion in assets under management, Vanguard manages over $8 trillion in assets under management, and State Street manages over $4 trillion. But we'll get to that in just a minute. To melt down the financial power further, BlackRock itself is equivalent to about 1/3 of the US GDP, and 2/3 to 3/4 of which is in passive managed funds at any given time. The big three now own on average 20% of shares of firms in the S&P 500, a figure that is forecasted to rise to nearly 40% over the next 2 decades, and BlackRock by itself has at least 5% of holdings in at least 95% of the firms in the S&P 500. This control allows BlackRock to wield substantial influence in American corporations through its vast holdings and significant shareholder voting power, using its voting power in shareholder meetings to shape corporate governance. This influence extends to critical matters such as board appointments, exclusive compensation decisions, and shareholder proposals. Its size and reputation gives BlackRock actions and statements on governance regarding climate change, social issues, even ESG to ripple through the financial markets, influencing broader corporate behavior and investor expectations. But back to the money, combined, the total asset value managed by all three of these companies equals approximately $22 trillion. And as you can see, that's a lot of money and power. But we will see how much further that power goes later in this video. For now, though, let's place a perspective on how much money this really is. As of September 2023, the median U.S. home price was sitting at $428,600. If the $22 trillion was, say, liquidated cash, and knowing that there are approximately 100 million single-family homes in the U.S., the big three could effectively buy up approximately 48.7% of the existing single-family home housing market. That's 48.7 million single-family homes. But of course, that is just based upon the national median average. And we know that all markets vary, so there is definitely an error to this analogy. But suffice to say, they could make a huge dent if they liquidated all of their managed assets and went on a huge spending spree on single-family homes primarily. This would massively swing housing supply and demand in the United States. But back to reality though, BlackRock, Vanguard, and State Street do possess a good number of investments in real estate investment trusts, or REITs, which cover investments over a wide range of real estate categories across the U.S. And those investments and subsequent REIT acquisitions are growing. Mike, what is a REIT? A REIT is a publicly traded real estate investment trust, or a company that owns, operates, or finances income-producing real estate. In order for a company to be a REIT, they must meet specific criteria under tax laws to qualify. Examples of the tax law include distributing a significant portion of their income as dividends to shareholders. There are primarily three different types of REITs. The first is an equity REIT. These own and operate income-producing real estate. They earn revenue primarily from rents on properties they own. Second, mortgage REITs, where these invest in mortgages or mortgage-backed securities rather than owning the physical properties. They earn income from the interest on the loans they originate or purchase. And lastly, there's a hybrid REIT. These combine aspects of both equity and mortgage REITs by investing in both properties and mortgages, as you couldn't have guessed. And as previously mentioned, REITs can cover a variety of different real estate focuses. To give you an example, Simon Property Group, which is one of the largest REITs, specializes in owning and operating shopping malls and premium outlet centers. Prologis specializes in logistics and distribution facilities, including industrial warehouses and distribution centers globally. And there's also the Realty Income Corporation, also known as a monthly dividend corporation. This focuses on single-tenant commercial properties primarily leased to retail tenants. However, there are REITs that directly focus on single-family homes for rental purposes across the U.S. These companies primarily acquire, manage, and rent out single-family properties. These companies include Innovation Homes, which is one of the largest single-family rental home companies in the U.S., owning and managing a portfolio of homes across the various markets. American Homes for Rent, another major player in the single-family rental sector. There's also the Front Yard Residential Corporation, which focuses on acquiring, renovating, leasing, and managing single-family rental homes. Tricon Residential Inc., which invests in and manages a portfolio of single-family rental homes, as well as multifamily properties. The Silver Bay Realty Trust Corp., which acquires, renovates, and manages single-family homes for rental purposes, primarily in select U.S. markets. And Colony American Homes, which previously operated independently before merging with Invitation Homes, focusing on single-family rental homes. While I'm sure the big three invest in just about all available REITs that they can, or that make the most sense for their investors, BlackRock, for example, has been known to invest in Innovation Homes and Tricon Residential, and Vanguard and State Street with Innovation Homes and American Homes for Rent. These investments are offered through a range of mutual funds and exchange-traded funds, ETFs, that invest in these various sectors, which include real estate. And while companies like BlackRock, Vanguard, and State Street are not the primary owner or operator of the companies like Invitation Homes is, or do not directly manage or operate the single-family homes for rent, their involvement in the financing and investment aspects related to the single-family residential sector is performed through its various funds and strategies. In summary, this approach allows the big three to leverage the expertise and dedicated real estate professionals while offering diversified investment opportunities to their clients. Make sense? Feels an awful lot like a shell game, doesn't it? Minus the fraud and illegal activities. Considering the term shell refers to a company that typically exists on paper with little or no significant assets or operations. Although Vanguard, BlackRock, and State Street are subject to disclosure requirements set by regulatory authorities such as the U.S. Securities and Exchange Commission or the SEC, the big three typically do not disclose specific holdings in individual companies or REITs due to fund management practices. And why don't they disclose them in full? It's because disclosing specific holdings could potentially reveal their investment strategy or trading positions, which could be exploited by other market participants or competitors. Instead, they file periodic reports and disclosures that provide information about the overall composition of their investment funds and portfolios to comply with regulatory requirements set by financial institutions such as the SEC. Tired yet? For the sake of this video and its length and its purpose, digging extensively through the specific fund holdings or disclosures provided by these asset managers is not going to be covered. If you wish to know more, additional information can generally be found in their regulatory filings or investment reports. Happy hunting. So let's focus on the single-family home REITs themselves through the numbers I could find. Innovation Homes manages a portfolio of over 80,000 single-family homes across various markets in the United States, according to their latest data. American Homes for Rent manages a portfolio of approximately 53,000 single-family homes as of recent reports. Front Yard Residential manages a portfolio of single-family rental homes, but specific numbers were not readily available in the most recent public disclosures. Tricon Residential manages a portfolio of over 30,000 single-family rental homes across various markets in the U.S. Silver Bay Real Estate Trust Corp manages a portfolio of single-family homes primarily in select U.S. markets. Specifically, though, their current numbers were not readily available. And Colony American Homes, now part of Invitation Homes, previously managed a significant number of single-family rental homes before the merger. But let's just focus back on Innovation Homes for that number. Adding up these homes, you might be saying, wow, that really isn't a lot of properties that they actually currently take care of, according to their numbers. And the primary amount of real estate investments in the U.S. still belongs to the individual private real estate investor. This is true. The crux of this video is, however, that the Big Three is capable of shifting investments to these REITs and the eventual control of one of the strongest investments in the U.S., which is real estate. And having the financial and political power to do it, it's a scary proposition. So then, Mike, if they have all of this money and power, what are they waiting for? Well, what are all of you waiting for? That's right, a real estate crash. If the real estate market were to crash, REITs with these strong financial backings could capitalize on several opportunities. One, and most obvious, is acquiring new properties at lower prices to expand their portfolios. Second, if the economy leads to a real estate crash, and knowing what we know from 2008, they'd be able to access cheaper financing, which reduces borrowing for their costs and boosts their profitability, should they even borrow in the first place. 3, they can maintain attractive dividend yields by distributing stable rental income to shareholders. 4, while they can also retain their tenants through favorable lease negotiation, stabilizing occupancy and rental and incomes. 5, they can also leverage those diversified portfolios to mitigate risks from localized downturns, ensuring stability. And 6, they can strategically deploy capital for long-term value creation through property improvements or repositioning to capitalize on market recovery opportunities. And that's not it. Controlling a majority of housing in the U.S. would give an entity significant sway over rental rates, property prices, and availability, potentially limiting competition and raising costs for renters and buyers. This control could also influence housing prices, zoning decisions, tenant protections, the shaping of community dynamics, and economic stability. With all of those advantages, though, some of the disadvantages is that it would definitely be raising concerns about fairness, equity, and regulatory scrutiny to ensure competitive markets and protect consumer interests. But such dominance would also likely attract scrutiny from antitrust regulators and policymakers. But let's analyze that. Would antitrust violations be there for the Big Three? Most likely not, for the investment is the REIT itself, and they're competing REITs. So antitrust, see where I'm going with this? Scary, isn't it? Well, they just did go after realtors for price fixing, but realtors and the NAR are not the government's friends. Not like BlackRock, which we'll get into in a moment. Financially, controlling a majority of housing in the U.S. also has several advantages. First, the entity would benefit from steady rental income streams from tenants across extensive property portfolios. This could provide stable cash flows and potential for long-term wealth accumulation. Second, owning a substantial portion of the U.S. housing market would give the entity significant asset value and equity, which could be leveraged for additional investments or liquidity. Third, with control over a large share of housing, the entity could influence market dynamics, including setting rental rates and property prices. This could maximize returns on investments and enhance profitability. Fourth, a diverse portfolio of properties across different regions and different types, like residential and commercial, would provide diversification benefits, reducing risk compared to holding a concentrated portfolio. And lastly, the entity's financial strength and market position would likely attract attention from investors, lenders, and regulators, leading to partnerships and access to favorable opportunities for growth and expansion. Partnerships, regulators. Oh, I think BlackRock already has that. Let's take a look at that pattern. BlackRock since 2004 has hired at least 84 former government officials, regulators, and central bankers, and that revolving door extends beyond the United States. For example, former UK Chancellor George Osborne was paid $850,000 annually to work 1 day a week. Other officials across the globe have also joined their firm. But beyond stripping the government for the firm, BlackRock has strong ties to Washington, D.C. For example, it was widely expected in 2016 that Larry Fink himself, who is considered to be a close whisper to the White House today, would have been Hillary Clinton's Treasury Secretary. But that didn't work out. Nevertheless, Thomas Donilon, who was chairman of the BlackRock Investment Institute, served as a national security advisor to President Barack Obama. President Joe Biden and Vice President Kamala Harris even followed President Obama's lead, turning to BlackRock when they sought out economic and financial advisors for the new presidential cabinet. For example, Brian Deese, a former BlackRock investment executive, serves on the National Economic Council. Adwale Adeyemo, former chief of staff to BlackRock's chief executive, is a top official at the Treasury Department, and formerly the global chief of investment strategist at BlackRock, Michael Pyle, is now the chief economic advisor to Vice President Harris. But Deese, Adeyemo, and Pyle also worked for the Obama administration. Even Eric Van Nostrand, a BlackRock managing director who is head of research at Sustainable Investments and Multi-Asset Strategies, exited to join the Treasury Department, being a senior advisor on economic issues tied to Russia and the Ukraine. So it's no understatement to point out that BlackRock has strong ties to Washington, D.C. Meeting calendars and phone logs revealed almost 400 conversations between BlackRock executives and senior officials in the White House, Treasury, and Federal Reserve since the financial crisis. Among other benefits, and despite its massive portfolio, BlackRock has avoided the same type of regulations put in place for other large financial institutions. Ties between BlackRock and our current administration also make sense because they share the same vision for the reform strategies of the United States. Socialism. Oh, I'm sorry. For example, in January of 2018, BlackRock CEO Larry Fink wrote a letter to the CEOs of major public companies, most of which he holds a substantial stake in, telling them that companies should serve a social purpose. Oh yeah? And increasingly, BlackRock integrates environmental, social, and governance factors into its voting decisions and engagement efforts. So putting the pieces together, are companies like the Big Three ultra detrimental to the American dream of home ownership here in the United States? I'd say that's a very safe bet. If the real estate market crashes and they invest heavily into REITs, as mentioned above, they can make it very difficult on the future home ownership in America, and potentially out of reach for most. The less homes available for purchase as they swallow them up for rentals would mean the leftovers would significantly rise in cost, to a level you may not even be able to afford. Supply and demand, remember? Mike, it will take years before it comes to that. You're just trying to scare us. And if the economy goes down, so will the Big Three. While there may be some truth to that, but will it? And will they? Let's analyze that. To answer this actually works hand in hand. The Big Three utilizes passive investing strategies like ETFs to function, as mentioned before. This passive investing provides protection against economic downturns through several key areas. One, by holding diversified portfolios that track broad markets. Passive investors spread risk across multiple securities, sectors, and regions, mitigating the impact of losses in any single stock or sector. Two, its lower management fees and trading costs as compared to active strategies help preserve more capital during market declines, enhancing overall portfolio resilience. And third, passive approaches also minimize behavioral biases that can lead to emotional decision-making, thus maintaining a disciplined, long-term perspective that aligns with a belief in market recovery over time. In contrast, active strategies may expose investors to concentration risks, higher costs, and the pitfalls of trying to time the market, making them potentially more vulnerable during economic downturns. So again, companies like BlackRock can do all of this while maintaining client trust during economic downturns. These factors would contribute to a more resilient financial position and operational stability for the firm amid market volatility. So would the Big Three be in trouble financially? Yeah, they would feel it, but not as much. Mike, I don't like this. What can be done to protect homeownership for everyday Americans like you and me? Well, one of the most obvious answers is to buy a home before they buy it for you. So if you are looking to buy, sell, or invest, please feel free to reach out to me. Get your slice of the American dream before they do. And if you are waiting for a crash before you buy, it could be the nail in the coffin for your homeownership dream. If you'd like to discuss this more, please feel free to reach out to me. But Mike, I can't afford to buy right now, not with the economy where it's at. What else can I do? Reach out to your local and state legislators today. Explain these concerns to them. It is clear that the federal government is in league with the big three, especially BlackRock, but the decision of laws and regulations governing the number of homes an institutional investor can purchase is made on a state and local level. Currently, regulations that exist are typically aimed at addressing housing affordability, neighborhood stability, and impact of large-scale investments on local housing markets. Some examples of the measures are anti-speculation measures that restrict bulk purchases by investors to prevent housing speculation, zoning laws that impose limits on rental property concentrations and set usage requirements shaping where and how investors can operate, tenant protection laws that govern eviction procedures and rent controls, which impact investor-tenant interactions, property tax disparities, which can affect profitability on investors, with some areas imposing higher taxes on non-owner-occupied properties than others, and affordable housing mandates. These housing trust funds require developers and institutional investors to contribute to affordable housing initiatives. These are just some of the ways local and state governments can work against institutional investors like the big three. And some states and local jurisdictions are already placing pressure on institutional investors. Believe it or not, some are. For example, in California, institutional investors face robust regulatory requirements in the residential real estate sector. Tenant protection laws, such as rent control measures and eviction safeguards, are rigorously enforced to protect tenants from sudden rent increases and unfair evictions. Major cities like San Francisco and Los Angeles also impose mandates requiring developers, including institutional investors, to incorporate affordable housing units into new projects or contribute to affordable housing funds. Although these primarily hurt the private American real estate investor, these measures pose a detriment to the institutional investor. In my honest opinion, however, when the private investor is finally pushed out of California and the institutional investor takes over, given the progressive politics of states like California, these mandates would probably be lifted against large institutional investors for their benefit. In Oregon, surprisingly, utilizes the best measures in my opinion, and that's the anti-speculation measure. This curbs real estate speculation. For instance, Portland has regulations that limit the number of properties that can be purchased by institutional investors in designated zones to prevent market distortions. Although it's in designated zones, it's almost on the right path. How about here in Idaho? Unfortunately, regulations specifically targeting institutional investments in residential real estate are generally less stringent compared to some other states. For example, while the property tax rates can impact investment decisions, Idaho generally does not have additional taxes or fees specifically targeting institutional investors in residential real estate. And regarding development standards, which can influence the ability of institutional investors to acquire and develop residential properties, Idaho also tends to have more flexible zoning regulations compared to states with stricter urban planning controls. Overall, though, on a local and state level, there isn't widespread direct limit imposed by states on how many properties institutional investors can own. Most regulations affecting institutional investors in residential real estate are centered around tenant protections, zoning laws, affordable housing requirements, and taxation rather than explicit caps on property ownership. While some states and cities, like in Oregon, have implemented policies to address concerns related to speculative buying and housing affordability, these measures may not establish direct limits on property ownership. So, what should you hit your local and state legislators with? In my humble opinion, institutional investment ownership caps or make the property taxes on single-family home REITs unbearable. Unfortunately, though, since local and state governments are funded by property taxes, it's highly unlikely that anything will be done about it before it is too late for Americans. They will own everything and be happy. Well, thank you very much, everybody, for taking the time out of your day to watch this video. I do hope that you found the information in this video very useful. And of course, if you have any further questions, please feel free to reach out to me or reach out to your local financial expert. And of course, if you do want to beat the big three to owning a majority of the properties here in America and you want your slice of the American dream, please feel free to reach out to me. I do know realtors all over the US and can put you in contact with great ones there. But also, if you are looking to move right here to the greater Boise, Idaho area, better known as the Treasure Valley, feel free to reach out to me. My contact information can be located in the description below. Also, if you're looking to move to the Treasure Valley, say from out of state, please click in the description below, download my free relocation guide, so that way you are in the know before you decide to make the move. If you really did like this information and you want to stay attention to all the videos that I do come up with in the future, please hit that subscribe button below, hit the notification bell so you're constantly in tune with all the videos that I do come up with. And if you're looking to sell right here in the Treasure Valley, please click in the description below and get your own free home evaluation. Of course, you probably will get a call from me, but I am not a pushy real estate agent. I'll more or less just kind of call and say hello and see if you have any questions regarding your home evaluation or any of the strategies to be able to sell your home in the quickest amount of time possible and for the most money in this market due to the conditions. So I hope to be of service in that area for you if you need it. However, before you go, if you like this information, please give me a thumbs up, or please feel free to share it with somebody that you know that might be affected by this information. And on this one especially, please leave me a comment below. I am not a financial advisor. I am a real estate agent. I would love to hear your thoughts on what you think is possibly happen if the real estate crash does exist and what the big three could possibly do to real estate. I've got my ideas, of course, again, on the real estate aspect of what could happen if the opportunity presents itself, but I would really love to hear your thoughts. So again, thank you very much for taking the time out of your day. God bless, and I look forward to the day that I call you my neighbor.